Trading order blocks will make you lots of money, either as a strategy or as a confluence to your strategy. In this video, I'm going to explain extensively what an order block is, the type of order blocks we have, and the rules for selecting the right order blocks. After this video, you're going to increase your win rate by picking the right order blocks always. So don't go nowhere. Ensure you watch this video to the very end, right? So welcome back to the channel, guys. If you're new here and you like videos that will help you level up your trading game, you want to click on the subscribe button so you can be part of the family. And also, guys, please click on the like button just to help the channel grow, right? So thank you very much for subscribing and for liking this video. Without further ado, let's dive into the video. So what is an order block? An order block simply means an area where orders are stacked, right? A zone where there are lots of orders in the market. Let's say this is a zone, right? Let's see, this is a zone, for example. It is a zone where orders are stacked. Now, it could be buy orders, it could be sell orders, right? But it is a zone where there is a high volume of orders, right? Now, as smart money traders, we see order blocks as an area of manipulation by the smart money traders. Now, what do I mean? We see order block as a zone where the smart money, right, the big institutions, right, come into the market with high volume of liquidity, thereby resulting to an impulsive move, right? Resulting to an impulsive move in price, either to the upside or to the downside. You could see market range this way, you could see market moving this way, and once a high volume of liquidity is introduced by the smart money, you're going to see a push, right? An impulsive push to the upside or to the downside, right? Now, that zone, we refer to that zone as an order block, right? As an order block. Now, so we are going to, let's look at what we are seeing on the chart, right? Let's just look at the charts. So this is an order block, right? First of all, you need to identify your breakout structures, right? You need to know or mark out your breakout structures to know, just to give you clarity, right? Now we have a breakout structure here. This is an order block, right? This is the zone where price started moving impulsively to break this structure, right? So it means at this zone here, liquidity was pumped into the market that forced price to move impulsively to break this structure, right? So we refer to this zone here, this zone down here. So that means this zone here is our order block, right? It is our order block. Likewise, this zone as well, you can see that price also moved from here impulsively to break this structure right here, to break this structure, right? So we refer to this zone as well as our order block. Why? Because this is where the energy came from. This is where the momentum came from to break this structure, right? To break this structure. So that's why we refer to this zone as our order block. Now, so what are the type of order blocks we have? Because we have two basic type of order blocks, right? We have the bullish order block and we have the bearish order block. Now, what is a bullish order block? Let's start with the bullish order block. The bullish order block is the last sell candle. The bullish order block is the last sell before the buys, right? The last sell candle before the buys. Now, so in this situation, right, we agree that this is an uptrend, right? You see price moving this way, creating series of higher highs. You see price is higher high, higher low, higher high, higher low, sorry, higher high, higher low, higher high, higher low, higher high, right? Higher low, and then a higher high. So this is more like a perfect trend, right? This is a perfect uptrend. Now, so in this type of, in an uptrend market, you will be interested in what? In bullish order blocks, right? And how do you pick the bullish order blocks? Or what are the bullish order blocks? The bullish order blocks are what? Are the last sales before the buys, right? So in this situation, look at this candle, for example. This candle is the last sell before this buy. this last sell candle here, right? This is the last sell candle before the buys, right? So this was the last activity of the buyers, of the sellers, sorry, before the buyers took over, right? So we refer to this as a bullish order block, right? The last sell candle before an impulsive move, right, is our bullish order block. Now look at this as well. Look at this as well. This is also a bullish order block. Here is also a bullish order block, right? Why? Because this is the last sell. This is the last sell before the buys, before this impulsive buy to the upside, right? So we refer to this zone as well as our order block. Now also look at this zone as well. Just look at this zone as well. This is what? This is our last sell before the buys, right? Before these buys to the upside, I went ahead to break this structure right here, right? So we refer to this zone here, to this last bearish candle here, as well as our order block, right? And this works across all time frames, not just the 30 minutes time frame I'm using right now. It works across all time frames, right? So this is our bearish order block, bearish or bullish order box. Bullish order block, bullish order block, bullish order block, right? Now the second type of order block we have is the bearish order block. The bearish order block is the direct opposite of the bullish order block, right? The bearish order block is the last buy activity, right, before the sales. So the last buy candle before the sales. And if you're looking for bearish order block, you should be looking for bearish order block in a sell market, right? Not in a buy market. For example, this is a buy market. If you're looking for a buy, if you're looking for sell order blocks in this type of market, you're always going to be stopped out. For example, let's say you're actually picking this order block as your valid order block, right? Or you're picking, let's say you picked this order block right here, this last buy activity here before the sell, right? Let's say you pick this order block as your order block. You're going to be stopped out, right? You're going to be stopped out. Why? Because you're actually trading against the trend, right? So if you're looking for sell, if you're looking for for bearish order block, you should be looking at a bearish market, right? You should be looking at the sell market. That's where they are more efficient, right? So now this is a bearish. These are all bearish order blocks, right? Because this is a selling market, so this is a bearish order block. This is a bearish order block, right? This last buy candle here before the sell down here that eventually led to a breakup structure, right? Led to a breakup structure. So this is a strong, this is a bearish order block. And here as well, you can see we have also a bearish order block here because this is the last activity of buyers before this sell that eventually led to a breakup structure, right? So you can see this. So this is how you identify your bearish and your bullish order block. Now, the next thing we're going to talk about are the rules. Yes, this is the most important thing. The rules for selecting valid order blocks, right? The rules for selecting valid order blocks. So we're going to look at the number one rule here. Number one rule here, let me clean all of these things and then try to paste it. All right. Now, so this is the number one rule. There must be a sweep of liquidity. Yes, there has to be a sweep of liquidity. Now let's look at an order block and try to follow these steps, right? Let's follow this step to select a valid order block, right? So number one says there must be a sweep of liquidity. Now, what is a sweep of liquidity? It's a situation where price takes liquidities, right? Where price takes stop losses of traders before moving, right? Now look at this zone, for example. Before this order block was formed, you saw that price took out liquidity here, right? Price took out stop losses of some traders, right? Because remember, I always tell us here on this channel that below every low and every high in the market is liquidity, right? Below every high or every low in the market is liquidity, somebody's stop loss, right? So look at this liquidity sweep that happened here before this move happened, right? So when we have this type of liquidity sweep, we say, okay, the other block that's going to be formed afterwards will be a valid order block, right? Now, so in this situation, we have our liquidity checked, right? We have our sweep of liquidity right here. And then the next thing you want to do, or the next thing you want to look out for is there have to be an imbalance, right? There have to be an imbalance or an fair value gap. You can call it imbalance, fair value gap, or inefficiency after your order block is formed, right? Now, what is an imbalance? Imbalance is the space or the gaps between price, right? Look at this gap here, look at this. In an ideal market, candles are meant to overlap each other, right? Candles are meant to overlap each other this way, right? There should be no space between candles. There should be no space between candles. So whenever there is space or spaces between candle, we refer to such space as an imbalance, right? And what do we expect? We expect price to always come back to fill up that imbalance, just to pay respect to the opposing party, right? Just to balance the market. So this is an imbalance. So remember, we have our sweep here, and now we have an imbalance that led to this tiny break of structure here, right? So we have an imbalance here, and we have our sweep. So that means this has been checked. Now, talking about inefficiency. Now, price inefficiency doesn't necessarily mean order block, right? Now, price inefficiency can refer to a swing inefficiency as well. For example, look at this, right? This is a new swing structure, right? Price just took out a higher high to give us a new higher high. Now, so between these higher high that's taken right here and this higher low that was responsible for this break of structure, right? This higher low, this higher high that was taken and this higher low that's responsible for the break of structure, right? We expect price to at least fill up to 50%, or we expect price to come down into this zone, right? We expect price to, after taking out the high, we expect price to come into this zone, to take out some liquidities, right? Because this zone here, this zone and this zone, this higher high that was taken and this higher low is a demand zone, right? Everything is a demand zone. So price could react from the order block or from the fair value gap or from any element of price here, right? So we expect price to, retrace into the zone, take more liquidity. So it will have enough momentum to keep going to continue the trend. But if price fail to retrace to this zone, we see it as an inefficiency, and we expect price to always come back to fill up this inefficiency. So inefficiency doesn't have to always be a single candle, right? It doesn't have to be a single candle imbalance, right? It will refer to a whole swing structure that price needs to retrace to, fill up to take orders, right? So yeah, so we have our inefficiency or imbalance or fair value gap checked. The next thing we need to also check is our order blocks must be unmitigated. Now, what is unmitigated? It means price untouched, right? You can just say it has to be untouched, right? It has to be untouched. You can see that this candle price has not reversed to touch it, right? So if, let's say, for example, if after breaking this high, price retrace to tap this order block before going up, it means the order block has been mitigated, right? It means the order block has been mitigated. We don't want price to correct to tap this order block. If price tap this order block before eventually going up, we will not consider this order block again because price has taken the liquidity, right? Price has taken the orders that was stacked here by retracing, right? So it means if price is coming here, the volume of orders will not be as heavy. It will not be as heavy as an unmitigated order block, right? So we want to have our order block unmitigated. We want to have enough orders when price visit this zone, right? To increase our chances of having of winning that particular trade, right? So yes, our order block is unmitigated. So we have this one checked as well. So the last one is you must align with the trend. It means you must be following the trend. You don't try to counter trend because you have a valid order block. No, when you do that, you're going to get stopped out. It doesn't matter if these three criteria were met. And if you fail to follow these last one, you're always going to get stopped out, right? So you want to follow the trend. Now, in this scenario, we see that price is actually, we see, okay, let me clean all of these things here. Let me try to paste it again. In this scenario, you see that we have a perfect uptrend here, right? Just look at this is a breakout structure. This is a BOS. You see prices moving, you see prices. This is a straight breakout structure, breakout structure again. And you see that this is a perfect trend, right? This is a perfect uptrend. So we know that the next possible thing that price can do is to what is to go to take out this high again as well, right? So this will be our anticipation. So when we are picking an order block from this zone, we have a certain we have confidence that price is going to go in our direction, right? So what are we going to do after meeting all of these criteria? After meeting all of these criteria, so the next thing we want to do is we want to, mark out our zone, right? Just map it out and, place, let me call price. So you understand what I'm saying. So you want to, map out your zone. This is our order block, right? You want to map out your zone, and then you're going to place your buy position here. Place your buy position on this zone here. And you're going to cover the higher low, right? You're going to cover the higher low. So our stop loss is going to be where our stop loss is going to be just below this higher low right here, right? Because if price takes out this higher low, it means we have been invalidated, right? The trend has been invalidated. So what are we going to do? We are going to then target this high, right? Because we expect price to give us a new high. So this is what we are going to do. We expect price to give us a new high, and we are going to, let's play price now. See, and that's it. We've been tagged, and you can see that, boom, right? So we're still waiting for these to actually play out, to play out, right? We're still waiting for these to play out, for price to take out this high here, right? And if price eventually takes out this high, if price takes out this high, right, it means we also have a new zone to consider. Only that we have a new zone to consider. This is the last bearish candle, right? Just that there is no imbalance here. There is no imbalance here. So we might not consider this zone because we don't have an inefficiency, right? So we'll not consider this order block, right? But this is how to trade order block. So the next thing I'm going to show you guys quickly is how to, the entries, right? The entries for order block, how to actually trade these entries, right? Now there are 3 or 4 type of entries, right? So let me clean all of these things here. Now, trading an order block entry, the type 1 is, trading the week, right? Trading the week. That means you would want to place your buy position. Let me call price here. So let's bring price all the way to this zone. So let's say this is your order block, having identified your, the breakout structure here. It's a breakout structure. And this is your order block, right? This is the last bearish candle before our move, right? And we are going to cover our higher low. So the first type of entry is using the wick of the candle, right? Covering the full, covering both the wick and the body of the candle. You see how I covered all of the candle, right? All of this candle here, right? Just this candle, covering all of this candle. So you can see that, right? So you expect price to what? You expect price to, you're going to place your buy position here, and you're going to also cover. So this time around, you're not now trading this type, you're not covering the higher low, right? You're only concerned about the candle, right? You're only concerned about the candle. So what are you expecting? That price will come here and give you a good trade. Now, why this is important is that you're going to have a good risk to reward, right? You're going to have a good risk to reward. If I decide to cover the full higher low right now, look at what we are going to have. You're going to have 4.76. Meanwhile, if I focus only on the candle, we are going to have this. Sorry, 4.7, 4.96, right? Meanwhile, if I decide to cover the full body of the candle, we are going to have, let me drag this down as well. Let me drag this down. We are going to have just 3.85, right? Although covering the body of the candle, the higher low, is actually more safe, right? Now, so the next type of entry is the body of the candle, just the body of the candle, placing your entry on the body of the candle, right? Placing your entry on the body of the candle. This is the body of the candle, right? And then your stop loss at the end of the candle, right? So this is the end of our candle. Let me just mark it out. This is the end of the candle, right? And this is the body of the candle. So we are going to place our buy position here and look at, now we are having 8.77 as our, as our risk to reward. Let's play price. If price actually came here, let's see. Let's see. And let's see. So price tapped it, and boom, price taps the body. You can see that price actually taps the body of the candle, right? Before eventually going ahead to, break structure to give us a very good trade. So you can see that. So price actually taps the body of the candle, right? But sometimes price might not tap the body of the candle, and it will just tap just the wick. It will tap the wick, right? And then just move. In such cases, you're going to have a missed trade, right? But in this scenario, price taps the body of the candle and it gives us a good trade and a good risk to reward. So meanwhile, we got 4 points something in the, when we use the body of the wick, when we use the full candle, right? We got 4 point something risk to reward. But in this case, where we used only the body, we got 8.7. So you can see the difference, right? Now, the next thing is the next type of entry is using 50%, right? You're just going to measure 50% of the candle, right? You're going to measure 50. You can use your Fib tool to measure it. You can use your Fibonacci tool, right? Use your Fibonacci tool. So using your Fibonacci tool, you measure from the top of the candle to the down part to the bottom of the candle, right? And then the middle line here will be your what? Your 50% zone, right? So that means you're going to place your buy position here, right? So you see that this is our buy position and this is the end of our candle of the candle, right? So that means in this, if we actually use this entry, we would have had 11.6 weeks to reward, right? You can see that now we have 11.66 weeks to reward. Remember the first entry we got 4 weeks to reward. The second one we got 8 weeks to reward. But this one using 50%, now we are having 11.66 weeks to reward, right? So you can see how these different entry types can give you different risks to reward, right? And this trade that we took here, this is a very good trade because it actually ticked all of those boxes, right? And you can see how, and then the last one, which is the fourth one, is is covering the full higher low or the higher high, right? Just covering all of it. This one will give you, this is the most secured, right? This is the most secured of them all, and it has the lowest risks to reward, right? I think this is also, natural, and even in our world today, if you're, the investment with the least risk usually give the lowest returns, right? So that's how this one is as well, right? If you decide to be, be more, if you don't want to lose a trade, or if you think more of your capital than the profit you're actually going to make, then you should cover the higher low or the higher high, right? And it will give you also a beautiful trade, just that you're going to have 3.92 as a risk to reward for this particular trade we are using as an example, right? So guys, if you haven't subscribed to the channel, please go ahead and subscribe and click on the like button. I'm going to leave in the comment section a quiz, right? So attempt the quiz in the comment section and I'll go through your answers and react to them, right? So thanks for watching, guys. See you in the next video. Peace.